join me in welcoming Nick Graetz.
Yeah, thanks, Devon. I'm going to try to just not use the mic. I'm on the tail end of a cold, so if anybody has trouble hearing me, just let me know. It's really great to be here in Michigan. I grew up in Minnesota, went to Wisconsin, but my grandpa went to University of Michigan, and he wore the same Michigan hat his entire life. So it has kind of loomed large in my imagination. Today, I'm going to be here for a few days at the Stone Center, so I kind of just want to do a real quick overview of other stuff I work on that's not this project, in case people want to drop by, talk about opportunities to connect. A huge part of my time right now that's been a project that got kicked up maybe 3 years ago while I was a postdoc at Princeton is this data linkage I've been leading with the Census Bureau. We kind of have a team that includes 6 or 7 folks in the Census Bureau on this internal RDC project. The goal is linking individual level eviction records to census administrative data. Some of this work's been published. A lot of it is hopefully ongoing. I'm worried about a lot of my colleagues right now at the Census Bureau, and the last couple of weeks have been pretty up and down with some of this work. But if folks are interested in working in the RDC or are working in the RDC, a lot of this linkage work involves IRS data, SSA data, LEHD, new data product the BLS is working on that collects student records and follows student outcomes at various participating university systems. So a lot of this is focused on how housing insecurity, especially eviction, interacts with all these data, but I've just been thinking a lot about RDC data linkage stuff, so if anybody wants to chat about that, definitely let me know. And then I also have a bunch of work on rental housing finance, and that's also kind of some linkage work, but particularly linking loan data, ownership structure data to rental properties and following how those dynamics at the owner-landlord level are shaping things like evictions and rent setting, especially in the pandemic, and the relationship of that to pandemic-era housing policy. But the work I'm going to talk about today is a newer turn in the last year that I've been doing with some folks at the Climate and Community Institute, as well as the Consumer Federation of America, really looking at the interaction of climate change with home insurance. And so I'm excited to present. The reason why I wanted to talk about this work here at Michigan is this is the first time I'm presenting this, and I want to take advantage of all the great intersection here of demography with really critical insurance, credit, risk, scholarship. So this is really going to be kind of a broad overview of this work that could go in a lot of different directions, and excited to get some good feedback while I'm here. So the climate crisis really represents an unprecedented challenge for societal risk management, and the American home insurance market has come under really intense scrutiny over the last decade for sort of how these risks have been estimated and managed, especially in the context of climate-induced disasters worsening. So we've seen this recently in the aftermath of disasters around LA, with the wildfires, around North Carolina. And beyond the human tragedy of these disasters, these events also have massive property damages associated with them. So the current estimate for the wildfires in LA so far is about $250 billion in damages. But many of the decisions about how these losses will be distributed are made way before they actually happen. So we can think about the damages associated with acute disasters, but there's also sort of this massive financial shift happening ahead of time that's affecting things like home values, how these costs are distributed through insurance markets. So besides, how we think about the acute disasters and sort of demographic, sociological consequences of them, we can also think about how these big tectonic financial shifts are starting to affect things like displacement, migration, population health. So this big study came out yesterday, covered in the New York Times, looking at the projected association between home insurance and home values. And they estimate that over the next 20 or 30 years, about $1.5 trillion in home value will be wiped out just by the way the values are affected by insurance markets. So this is sort of, again, an example of these big shifts that are happening that affect things like the American dream, how stable of an investment is home insurance? How likely is it to build families' wealth over their lifetime? These are all big changes that are happening before buildings flood or are hit by wildfires and are affecting decisions folks are making about where to live, where to move, where to invest. So how does the home insurance market fit into climate change? The story of the last maybe 5 years has been that as disaster-related losses have increased, insurers have really been underestimating risk. So there's kind of some acceptance that the models of risk related to floods, fires, hurricanes, generally we're underestimating the likelihood of these events. And so in some ways, private insurers are playing catch up in terms of trying to set rates in a way that reflects risk. Before thinking about issues in the private home insurance market, there's also issues of uninsurance. So some insurance markets have some kind of direct mandates. The home insurance market, there's kind of an indirect mandate where mortgage lenders will require you to have home insurance. But a lot of folks don't have a mortgage, have already paid off their mortgage. And so according to a big report from the Consumer Federation a couple years ago, we have about $1.6 trillion in uninsured property value across the country. And this reflects about a 7.5% uninsurance rate for homeowners. And so again, this is because mostly reflecting folks who don't have a mandate through their mortgage lender. And so this uninsurance problem is also seeding a lot of these big systemic economic risks. So we can think about brewing financial crises at the local level in terms of solvency of local governments, especially more smaller governments that really rely on property taxes as their primary form of revenue. And folks are also starting to write and think a lot about how these broader economic systemic risks might be seeding sort of 2008-esque global financial crises. And so today I'm going to be talking about issues that exist within the private home insurance market for folks who are insured. And so when we think about issues within the home insurance market, there's a couple big patterns that folks have highlighted over the last few years. So one is that state regulators make a lot of difference here. Generally, policyholders in unregulated states like Oklahoma are probably subsidizing very regulated states where rates are kept very low, like California. We have state-level public programs, the FAIR program in California, Citizens in Florida. It's pretty widely accepted that these programs in home insurance suffer from extreme adverse selection. So they sort of have very quickly become the insurer of last resort, only include the riskiest properties. And so prices have increased exponentially in these programs over the last 5 years, especially as private insurers have left certain markets like California and Florida. It's been a massive shift of folks onto the really expensive Florida public plan. And so generally, private insurance premiums have increased. I think the average across the country since 2019 is 32%. But in a lot of the country, Louisiana, South Carolina, we're talking about 50, 100% increases over the last couple of years. And so for homeowners who, in a lot of these states, you have a pretty large chunk of homeowners who are making 50, 70K, this can quickly become 10 or 15%, 20% of folks' annual income. And so before I get into the present study, also just keeping in mind this landscape of home insurance in the United States, home insurers remain highly profitable. So in the news, there's a lot of coverage and framing of home insurers talking about these really big correlated losses, like the wildfires, and how that's why they need to raise rates, all these things. And regardless of that, revenues minus costs is not the whole profit story for home insurers. Most home insurer income is from investment income. So a lot of home insurers, this still remains a fairly profitable industry, despite this huge rise in costs. And we'll see how long that lasts, but I think that's just something to keep in mind as we move through and frame some of the work I'm going to be talking about today. So in a lot of my research broadly, I'm generally interested in how risk is constructed and managed through the housing market. and how this ultimately affects things we care about as demographers, sociologists, like migration, health, mortality. And climate change affects these processes not only through the direct impact of acute events like floods and wildfires, but also through the contested ways in which the actuarial risks of these events are estimated, valued, and redistributed across society. So I think right now there's a lot of really great demography and sociology coming up about displacement related to acute events. How can we assume these things are going to affect patterns of domestic migration across the US? But I think less work on sort of how are these broader financial shifts affecting people's housing costs, displacement, where they're moving, who's moving into those places. So these are some of the questions I'm going to talk about today, and also where I see a lot of this work going over the next few years. So the primary research question I'm going to talk about today with this study is trying to sort of start to unpack this black box of how do home insurers set prices, and to what extent do home insurers rely on individual level data. So there's kind of it's accepted in health insurance markets, auto insurance markets, that insurers are using a lot of individual level data to estimate risk and set prices. Home insurers also collect and use a lot of this data, even though we really focus on environmental risk when we're talking about the home insurance market. So what are some consequences of that? As climate change worsens, how is this affecting how we think about distributing the risks and costs associated with climate change in a really individualized way versus a more collectivized way? And ultimately, who's making these decisions? How is this happening through this patchwork of largely private actors? So before diving into the home insurance price setting, just want to do a really quick overview of risk-based price setting in insurance markets broadly. So we can think about risk-based pricing for any given policyholders existing on this spectrum from a policyholder's paying a cost that's exactly proportional to their risk they're contributing, or there's full risk sharing where every policyholder pays the same amount no matter what. And the extent to which we move to the right side, there's more cross-subsidy paid by lower risk folks to subsidize higher risk folks. So we can think about more public programs, social insurance existing closer to the right side, and more of the private insurance industry existing closer to sort of some true risk-based pricing. And because risk for any individual is almost impossible to estimate exactly, we're always going to be in the middle here somewhere. So there's always going to be some subsidization happening. So why do private insurers use risk-based pricing? Why, when you buy a home insurance policy, do they want to charge you something close to the amount proportional to the risk you're contributing? There's this basic economic model of avoiding adverse selection in the insured pool. So private insurers want to attract low-risk folks who are going to only pay if they are charged a lower price. And they also want to account for the fact that higher risk folks are going to probably cost them more. And in that sense, there's also this sort of consequence of this model, which is price signaling. And so this comes up a lot in the framing and discussion around home insurance, especially as private home insurance has become sort of our frontline societal response to climate mitigation adaptation. So for example, insurers argue that having risk-based pricing builds in this price signaling model where folks will try to reduce their risk because it lowers their prices. So it relies on this perception among policyholders that their price is causally related to some risk factor under their control. And so by reducing those risks to reduce their prices, they can bring down costs, as well as avoiding so-called moral hazard, right? Where in a model where there's full risk sharing, certain individuals might say, well, if I can behave in any way I want without it affecting my costs and taking on no extra cost myself, then I might do that. If I have car insurance, maybe I drive more risky. If I don't think I'm not gonna have to pay for it if I get in an accident. You know, that's kind of the flip side of the coin to price signaling. And so this concept of price signaling is going to come up a lot as I talk today, and we talk about home insurance and how this idea of how home insurance is acting as this model or not for climate mitigation, reducing the risks of climate change. So in principle, risk-based pricing includes these three broad probabilistic inputs. We've got your price should basically be the expected payout in the case of a claim, the likelihood of a claim in the case of an insured event, and the likelihood of an insured event. And so when insurers are thinking about these first two, these are largely predictable, largely deterministic in terms of policy details. How much coverage are you buying? What's the legal process insurers are bound to for processing claims? But it's this last part, the probability of an insured event, that has to be modeled in some way. And so what I'm going to get into today is how do home insurers think about modeling this risk? How do they think about this risk of how likely is this particular house to be damaged in a hurricane? And so the way they do that is basically collecting a lot of different variables, risk factors, things that they think are related to this risk. And that happens in a lot of different ways because, there's virtually infinite factors that are predictive of risk. And so there have to be some decisions made immediately on, well, what do we think is associated with risk for a home? And so some of this comes out of sort of seemingly common sense ideas about where the true risk of an insured event lives and how insurers think about that question, how actuarial science thinks about that question. So there's kind of these three broad buckets, and I'm just going to use auto insurance as an example. Insurers will think about, well, the true risk of the event lives in the covered asset in some way. So this could be how old is your vehicle, other characteristics about it. Risk lives in the environment in some way. So insurers think, well, different road conditions. I'm gonna, my car insurance was a lot more expensive when I lived in Philly compared to now in Minneapolis. There's different vehicle interactions. And then insurers will also talk and think about how risk lives in the individual in some way. The individual who has control over the covered asset. So in auto insurance, they'll talk about reckless driving behavior. Certain individuals are just more responsible, more reckless, more risky. And there's this idea that that risk can be captured in some way through individual level variables. But there's a lot of other determinants of how insurers pick variables to put inside their pricing models. So besides these ideas and concepts of like where risk lives, there's also just the ecosystem, the political economy of data collection, surveillance. How easy is it to collect data? How seemingly easy is it to measure these characteristics accurately? So how easy is it to measure something about the foundation of a house versus the gender of an individual? Insurers, have different ideas that are socially and culturally constructed and built out of these data systems where today we have a massive ecosystem of individual level data collection. So when you go to sign up for a policy, health, auto, car insurance, the insurer knows tons of things about you as an individual, even while they might not know that many things about your house. And that also intersects with sort of what they see as socially salient categories, things like gender, things that they think are related to risk in some way. And ultimately, these things interact with what can be a lot or a little regulation. So when we think about anti-discrimination law, we can think about how insurers can't use race or religion to set prices, but they can use gender. They can use a lot of other individual traits that are protected in other industries like housing, labor markets. You can't do that. But insurance sort of is the last bastion of many of these categories are completely fair game for setting prices. And so a lot of great work coming out of sociology of risk and insurance. There's a case that these determinants often seem more important in insurers selecting variables for their pricing models than my last slide of this list of some kind of very strong theoretical foundation of where does the risk actually live? What do we actually want to measure? So when we think back to how do insurers actually set these prices, that sort of first principle probabilistic price setting model gets reduced to some kind of black box of prices are set as some unobserved nonlinear function of all these inputs to the pricing model. So some of these will be policy related. How much coverage are you buying? What's your deductible? But then a lot of these inputs are all the information insurers can collect about the asset covered, about the environment the asset's exposed to, and about the individual who theoretically has some kind of control over that asset, or is the asset in the case of health insurance. And so what I want to do in this project is really start unpacking this black box of price setting in the home insurance market. And how can we think about doing that? So the way insurers will say that they set these pricing models is essentially creating an empirical model of past claims. So they have a lot of data on, well, who gets into car accidents? How much does this sort of asset in this sort of environment controlled by this sort of individual typically cost me from all the data that I've ever collected on car insurance, home insurance? So in some way, there's kind of this empirical analysis going on behind the scenes. And I think today, this probably is largely driving in a lot of ways price setting. And so I'm going to talk a little bit about how, even if we're using this empirical analysis, what are the implications of selecting and using these different variables in the analysis, using things like individual level data to proxy other things insurers I really want to know about assets or environments. But I think it's also important to note that even beyond this empirical analysis, there's all sorts of other reasons insurers might set prices in different ways. So historically, we've had a lot of examples of insurers charging different policyholders different amounts based on normative theories of risk. We can think about how this shows up in lending and credit markets. You can think of the example of redlining, where Black homeowners were charged different rates, despite the fact that there was no empirical analysis showing differences in foreclosure. And we can also think about literature on exploitation and price discrimination in insurance markets. So I think there's pretty good evidence that low credit consumers are less likely to shop around, and insurers raise their rates faster for that reason. Assuming, ultimately private insurers are profit maximizers. So if they can identify certain consumers and push up prices without losing that market share, they will. But I'm really going to focus here on what are the consequences of doing this big empirical analysis of past claims? What are the consequences of including a lot of individual level data in doing that, rather than so much asset and environment data? And what does that mean for how we're spreading around the costs of climate change? How are we really individualizing what is really a big social collective problem? So in home insurance, there's kind of this difference in the framing and the public discourse. A lot of reporting around home insurance in New York Times, Washington Post over the last few years as this crisis has been brewing. In contrast with other insurance markets like health insurance, car insurance, the focus is almost exclusively on this idea that, well, prices in home insurance are, of course, driven by asset risk, construction quality, how old are homes, and environmental risk. Where are homes located? So while in other markets, there's some focus on, in health insurance, we talk a lot about pre-existing conditions, other individual level traits, whether they should or shouldn't be used in setting prices. In the home insurance market, the focus is almost exclusively on this idea of asset and environmental risk. And that sort of is, especially as environmental risk has been captured more in pricing, that's what's driving up and really determining how much you're going to be spending on home insurance. And this is really related to this idea of price signaling. So there's this huge push by insurers to argue that price signaling is really important for reducing climate risk because we need to signal to people that they shouldn't be living in certain places. And so part of that is sort of future looking of we should disincentivize through high insurance prices, new construction, people moving to the coasts. But there's also this idea that we should send price signals to the people currently living there. So if we raise rates at a really high rate in risky places, we should be trying to incentivize people to move from those places. And this is different than like public programs. Like there's a lot of discussion of public programs related to ideas around managed retreat, more progressive or equitable subsidies for especially low-income homeowners. This is sort of like a purely private market price signaling mechanism. That this should be a primary way, this can be a primary way that we adapt to the consequences of climate change and ultimately avoid people experiencing these losses and abandoning places where they're going to be underwater in 20 years. But despite this framing, home insurers still collect and use all the same individual level data that health insurers do and auto insurers. So we know that they're collecting all this data. What's your level of education? What's your credit score? And maybe using this in some way to set prices. And so there's this question of, do all insurers kind of think of risk this way now? Of, well, I just get all the easiest data I can to collect and I put it in my big black box empirical model and I get something that looks like risk-based pricing. But how much are we relying on these things like education and credit score to proxy past claims through environmental risk or asset risk or something like that, through these kind of non-causal relationships. So why do home insurers collect and use all this data? We can think back to those reasons of because it's really easy and cheap. It's much easier and cheaper to get someone's credit report than it is to get a report on the foundation of their home. These are tend to be really salient social categories for insurers and actuaries. And there's virtually no regulation. In the home insurance market, in health insurance, there's a lot of regulation around individual data that can be used. In home insurance, there's basically no regulation about what can be used in the price setting models. So up until now, this has still existed as this huge black box. And we're kind of talking about rising premiums, what we should do about it. But we haven't really unpacked this box of where are these prices coming from? How are they being set? And in home insurance, I think there's some really important and interesting implications of using something like credit score to set someone's home insurance premium. Home insurance, I think, should be the market where these proxies of individual risk are theoretically least important in predicting the true risk of insured events. So in contrast to markets like auto insurance, health insurance, where there might be some more proximate connection between individual characteristics. But there's also this question of even if credit scores do predict past claims, so even if they are predictive, they are an effective proxy of past claims, there's still all sorts of important social and collective issues about using them as a proxy for past claims. So a really important one, especially when we think about can the private insurance market save us from climate change through the price signaling mechanism, disincentivizing new construction, incentivizing people to leave risky areas. Credit scores don't serve any price signaling function. So even if they're a good proxy for past claims, you can't reduce the risk your home is going to be hit by a hurricane by increasing your credit score, right? It also kind of by definition is systematically shifting the cost of climate change to more marginalized consumers, right? So if we're charging lower credit score folks more for home insurance just because they're low credit score, this sort of all wraps into this, the last few decades of this really individualized idea of risk, kind of the idea of the credit score as this composite indicator of personal responsibility, individual risk. And a lot of folks have written, about how this not only shifts cost to more marginalized consumers, but also this whole idea that we can have these general proxies of individual risk, so-called off-label uses of credit scores beyond their initial, their origin of determining lending decisions, are kind of rooted in what often are racist logics of risk exists in individuals. Certain individuals are simply more risky, less responsible. And so when we're using those kind of logics to shape these massive questions like where are we distributing the anticipated trillions of losses from climate-induced disasters, how are these sort of going to entrench and reproduce systems of inequality that we've been building, especially over the last century as we've started really using things like credit scores to shape our financial markets. So I'm going to talk about some kind of unconventional data I've been using to explore this question today, and really just focused on these two really straightforward research questions, which are how large is the marginal effect of environment on home insurance prices? How large is the marginal effect of credit score on home insurance prices? And how do those two things stack up against each other? So like I said, there's a lot of focus on this one when we think about the home insurance market and the brewing crisis of home insurance. There's this argument that, well, we want this really big marginal effect of environment. We want to signal to people where the risky places are. But there's this open question of, well, how big are the marginal effects of all these other things insurers are putting in their algorithms, like these individual characteristics like credit score? So this is a pretty tough thing to estimate, right? What's the marginal effect of a particular variable in an insurance pricing model, which are these kind of black box, crazy nonlinear functions that insurers really don't want to share. So we can kind of think of two options for getting at marginal effects of a particular variable in pricing. One option would just be directly observe the data generating process. So in this case, that would be accessing algorithms directly. And the second option, which is much more common, is modeling the data generating process, right? So use data on observed premiums. What are people actually paying? Because they can tell you that. And then fit some sort of so-called hedonic price model that's basically predict observed premiums with a bunch of stuff we think insurers are using to set prices. And so there's a couple really big obstacles or limitations with both these approaches. For the first one, it's, unless you work for an insurance company and have access to a pricing algorithm, these are really proprietary, really closed door. It's hard to get directly at what are the price effects of every variable that goes into the pricing algorithm. For the second option, it's a little easier in practice to fit this kind of model, but these are always going to be subject to really big issues of measurement error in terms of, are we using the same variables the insurer is using? Are we measuring them in the same way? And then model misspecification of basically what's that function? I can fit a linear regression model with a bunch of stuff that I think is related to the price, but like, does that coefficient, how closely does that coefficient correspond to the actual pricing effect of that variable in whatever kind of crazy algorithm the insurer is using? So to try to get at some of these questions, which I've kind of been discussing with folks, collaborators who have helped with this data at the Consumer Federation of America, as well as the Climate Community Institute that I work at. We've identified this sort of third-party data vendor that provides pricing analytic tools for the home insurance market. And so this group called Quadrant works directly with insurers to either directly access their pricing algorithms or scrapes and collects data on ratings plans that insurers are required to report to state offices of insurance for regulators to look at, which is going to vary a lot by state. But Quadrant essentially puts together all this data through relationships with insurers or scraping data from state offices and builds this real-time premium quoting service for their primary client, which is online insurance sellers. So what they're trying to do is basically build a premium quoting service that covers the whole private market of home insurance, and then sell that database to folks like Zillow, who want to be able to say, if you buy a house here, here's how much you're going to get charged by Geico, State Farm, all these other insurers for home insurance. So I can talk a lot about the issues and limitations with relying on like these black box private data vendors at the end, because I think there's a lot of problems with doing that. It's kind of getting us away from our primary data collection roots. But I think this is one of the only ways we can really get at this question of marginal effects in insurance pricing decisions. So when we think back to the black box of home insurance prices, where price is some unobserved nonlinear function of your policy details as well as all this other stuff that insurers collect information on. According to Quadrant, home insurers use about 157 variables to set their prices. These include all sorts of standard policy information. So basically just what are you buying? What are you going to get if in the case of an insured event? A lot of these variables are related to the asset. So how old is the house? What's the roof made out of? When was the roof last replaced? Things like that. What's the square footage of the house? What was the last valuation of the house? In terms of environment, we have zip code. So where's the house located? And so that's going to proxy, as I'm using it here, kind of anything about geography, right? So that's going to pick up sort of environmental risk, but also anything else about zip codes insurers think is important. And then they also collect tons of individual level data. So home insurers collect and use in their pricing algorithm, according to Quadrant, age, gender, education, and credit score. So basically what we did is we asked Quadrant to produce price estimates for every home insurer across the United States in every zip code in 2021 and 2024. How much would the exact same home insurance policy cost for the exact same house, where the only thing that's different is the zip code the house is in and the credit score of the individual? So essentially what we're doing is we're asking them to produce marginal predictions from the pricing algorithm, where we fix everything at sort of national medians or modes, except those two variables. And so this will actually let us get at that question, if we trust this data, which is a big leap. But if we trust this data, that having marginal predictions can let us get at this question of, well, what's the marginal effect of credit score compared to zip code, where we've fixed everything else. So you can kind of think as like, that's the data I'm working with in this project, right? This big set of marginal predictions where for every zip code, I have 6 different marginal pricing predictions. I have them by credit tier, which I'll talk about. They split it up into, when they give it to us, they split up into just these 3 sort of crude buckets. And then we also, to look at some change over time stuff in how insurers are setting prices, we asked them to do in 2021 and 2024. And so again, I can get into this more at the end if folks are interested, but in terms of how exactly we're setting all these other 155 variables, but we're just using the national typical values. So you can think of this as I'm buying the exact same standardized policy for what looks like the exact same home Exact same coverage, exact same deductible. The only difference is what zip code is it in and what's the credit score of the person wanting to buy insurance. So before getting into the results, just a quick note on those credit tiers, which I'll talk about, that I'm just going to call high, medium, and low. These are the buckets that they report quotes for when they give us the data. And these generally cover pretty well the range of credit scores among American homeowners. So this is according to an analysis from the Urban Institute from a couple of years ago. So just keep in mind when I'm talking about low, medium, and high credit, folks, this is generally the range, the relative percentile range I'm talking about in terms of American homeowners. So first, let's just look at a map here of the zip code level average prices. The other thing I should say is that we get price quotes from every active insurer. And in this project, I've aggregated over the company, over insurer. So I'm just talking about one price, sort of average price per zip code. At the end, I can talk about some other projects we're doing, actually looking at company level variation in this stuff. But for now, I'm just talking about the average quote across all companies in that zip code. So this map is the marginal home insurance price. So for that standard policy, how much are you going to pay? Where the only thing different is what zip code are you in. And so this ranges from about 500 to 7,000. And this looks pretty similar to observed premiums. So there was a big study done trying to infer observed real premium costs for homeowners using mortgage data. This is from the New York Times a couple years ago from Keyes and Mulder. And you can see those two maps kind of look the same, right? So we have these really high rates in the middle of the country and along the south and east coast, very low rates in the west coast. But the benefit, right, of having the marginal prices is I can compare these across zip codes and know that the only difference is the zip code and not the fact people in different zip codes buy different levels of coverage, all sorts of different policies. We can compare this to a map of disaster risk. And of course, this is, insurers will say they have all this proprietary disaster risk data that, I don't have access to. This is just from FEMA's National Risk Index of the expected loss rate rank for every zip code in the country. And so the more yellow places are higher risk of higher expected percent of property value lost every year to disasters. And so there's a couple big discrepancies jump out here right away, right? A lot of disaster risk on the West Coast that doesn't show up in those prices. And also that disaster risk doesn't really respect state boundaries, right? So it's much smoother across space, whereas in our marginal price map, we have these really sharp state boundaries. So before getting into the comparing the marginal effect of zip code to credit tier, I also just want to examine a little bit this variation in zip code level marginal prices. Like, what does this look like? Does it look like climate risk? Does it look like something else? So I fit some basic models where here I'm showing the standardized coefficients of zip code, proportion, non-white, median income, and expected loss rate for those marginal prices. And I've played around with some different nonlinear models here, but generally things look about like this, which is that there does seem to be a big effect of climate risk on your marginal price. So how much geography matters for how much the insurer is going to charge you, where higher expected loss rate, higher premium. But there's also fairly big effects of the marginal price associated with the zip code is going to be higher for lower income, more non-white places, conditional on climate risk. So this gets at that question of like, why do insurers charge different zip codes different amounts? It seems to have something to do with the climate risk associated with that geography, but also other stuff, other unregulated things about how insurers are allowed to charge different geographies whatever they want to. I also do sort of just a basic Shapley decomposition of that model to look at, in a model where I just have zip code level climate risk, I can really explain maybe 18% of the variation marginal prices. When I include a state level fixed effect, the state of residence explains about 45% of variation, those zip code level prices. So the regulatory environment of states really matters in how much you're going to pay for home insurance. And then there's some more here I can talk about more at the end, where I basically rerun that analysis for every state separately. So just looking at within state variation, because there we should say, well, that doesn't have to do with the state level regulatory environment. We can just say within state, within North Carolina, how much does zip code level climate risk explain geographic variation of those marginal prices? And the highest state, I can still really only explain about 30% of variation. Most states, all the different risk metrics I've tried to use, which again, I'm limited to public data, but really don't explain a lot of the geographic variation in these marginal prices. So this is all kind of building up again to like, what is this price signaling mechanism? Is it effective? Is it actually happening? Are insurers actually signaling where the risky places are through the way they set prices? And it seems like maybe not. So to get into my primary research question here of the marginal effect of environment compared to credit, here I'm ranking every zip code from least expensive to most expensive for high credit homeowners. So these are folks who insurers think this is a very low risk individual. The only difference here is what zip code do they live in. So we can interpret the difference between these marginal predictions as the marginal effect of environment, right? This is the marginal effect of if you live in the least expensive to most expensive zip code in the country, how much more are you going to be paying for home insurance just because of that zip code? And so it looks like on average it's about $5,000 a year. I then compare this to medium and low credit homeowners living in these same places. So if you're a low credit homeowner living in the least expensive zip code, how much are you paying relative to high credit homeowners? And so this gap is the marginal effect of credit score, right? This is, you're buying the exact same policy for the exact same house in the exact same zip code. The only difference is you're a low credit homeowner instead of a high credit homeowner. And so we find that this effect looks a little over 2,000, pretty stable across the whole distribution of prices. We can also pull out some sort of stylized facts here about this pricing distribution, such as if you're a low credit homeowner living in the 25th most expensive zip code, you're going to be paying the same price as a high credit homeowner living in the 80th most expensive zip code. And again, we're kind of thinking of these zip code ranks as that should be capturing disaster risk associated with geography. So I also just put these marginal predictions in terms of average marginal effects over here, where I've got the effect of a 50 percentile increase in your zip code rank from your high credit homeowner. And then I've got the marginal effect of being a medium versus high credit homeowner and a low credit versus high credit homeowner. And so this is sort of like the price signal, right? This is how much more are you paying for living in a riskier place if you're a high credit homeowner buying the same policy. And we can kind of compare that to these credit penalties where it looks like having medium credit instead of high credit, which is describing a lot of the American homeowner population, is on the same scale as about 25 rank change in where you live in the country. Being a low credit versus high credit homeowner is even more than that. Maybe I think about 65 rank increase in where you live. And then there's also these questions of like, who is the price signal stronger or weaker for? And there's also some evidence of interaction effects here of this orange line is steeper than the black line. So the signal that you shouldn't be living in a high risk area is stronger for poorer consumers. So this has some implications for like, who is that price signal for that you should leave a risky area? So when we think about like the wildfires in LA, who's being signaled that they can rebuild and get insurance there versus who's being signaled that they should leave? And then just to talk about change over time a little bit here, I compared these average marginal effects in 2021 in the white dots to those effects we just talked about in the black dots. This credit penalty has been increasing really quickly over the last 3 years. And we compare that 24% change to just an 11% change in sort of the force of geography in shaping home insurance prices over the last 3 years. So just to summarize what we've done so far and thinking about different directions for these projects going forward, there is a substantial marginal effect of environment as captured through zip code on home insurance prices, which is this is what all the framing is about of the home insurance crisis. This is what all the framing is about in terms of this price signaling mechanism in the private market. But we also find this huge substantial marginal effect of credit on insurance prices that is basically on the same scale as moving from one of the least climate risk parts of the country to one of the most climate risk parts of the country. And both of these effects are larger in zip codes that are lower income and a higher proportion non-white. Again, remembering that we've sort of marginalized out all of the differences between those types of zip codes. So it's the same policy, same houses. This isn't because folks in these kind of zip codes have lower value homes or something. So there's a bunch of huge limitations about relying on this data set. So one sort of broader consideration when we're talking about marginal predictions is common support problems. Is this just extrapolation because we're using these national medians looking everywhere? I've rerun the analysis a bunch of different times with different subsets of zip codes. So I've looked at how do things look if I only look at like the 10% of zip codes with the most mixed homeowner populations. And zip codes are actually kind of nice for this reason because they're much less homogeneous than census tracts, where there's actually a lot of zip codes in the country where you get a lot of presumably, I use income to sort of proxy this, but presumably low income folks or low credit folks and high credit folks living together. And so these average marginal effects of credit score on home insurance price look the same in those subsets. So it doesn't really seem, I think this is a limitation we can actually sort of try to unpack a little bit and do some sensitivity analysis around, but it doesn't seem like this is a common support thing or that there's something weird about extrapolation happening here. I think the bigger issues that we can't really do sensitivity analyses on are just the reliability of industry data vendors. So Quadrant, their product is the data, and it's not produced for research. It's produced to sell to insurance comparison tools. So, they're selling the fact that they have this really accurate real-time quoting service based on accessing these algorithms, working with state filings at the state insurance offices. And we kind of just have to trust them on that. There's also the issue of home insurance policies. These comprehensive home insurance policies don't necessarily cover all disasters. So we've split out flood insurance, for example, in the United States from comprehensive home insurance. And in some states, other things have been split out as well. So these policies I'm talking about don't cover earthquakes in California, for example, which have been separated into a different market. And these policies also do cover non-disaster events. So like kitchen fires, burglaries. So today, the majority of home insurance claims are from disasters. But just keeping in mind that maybe insurers are using credit scores to proxy these other kinds of losses, like kitchen fires or burglaries. But let's just think about that question for a minute. What if credit scores do predict higher claims in home insurance? So what if credit does predict these non-disaster events and losses for insurers? What if credit does predict disaster damage because certain homeowners are more likely to reinforce their windows in certain ways or something like that? What if credit does predict something unobserved about disaster risk within zip codes? So in those mixed zip codes, lower credit folks might have a house that's in an extremely localized, more risky area than high credit folks. Even if all those things are true, we still get at these tricky problems of prediction versus causation in insurance pricing. So insurers, for the price signaling mechanism to work, we have to be using causally, there has to be some causal connection between the input variable and the price you're paying. And I think this also just has, again, these big societal implications for how are we sharing and distributing costs in general. Are we using really causally proximate things related to environment and climate change, making really intentional decisions about those things? Or are we just relying on this train that has left the station a little bit in the insurance industry broadly of, well, we just scrape and use lots of individual data. That's just how we set prices. Just to wrap up here, I wanted to point out some really interesting work on public opinion around cost sharing and risk-based pricing. Rand did this huge study that came out a couple months ago about like, well, what do people think about like, how should we share costs? If I'm a low risk person, do I want to share costs with a higher risk person? And I think it's a really interesting study because in general, people report wanting to share costs. The people report wanting to share collectively as society share the costs of climate change. People report wanting to share costs with high-risk policyholders, even in markets like auto insurance. But people report a really strong desire for insurers to use causally proximate variables in setting prices. So this example from their work on auto insurance, when they said, should auto insurers be allowed to use credit scores in setting prices, 20% of people agreed with that. When they said, if you have more speeding tickets, should you be charged more? Almost everyone agreed with that. And the interesting part of the survey instrument is they made a big point of informing people that both these things are predictive of losses, that both of these things are predictive of getting into more car accidents. And people still said, well, you shouldn't use credit score to set prices. But insurers do this. This work is unpacking, my work I just presented, we're unpacking how it's happening in home insurance, which is this interesting site, I think, for interrogating some of these dynamics, again, because there's an assumption that individual data is just not really used in the home insurance market. But there's been a lot of great work, again, by my friends at the Consumer Federation about credit penalties in auto insurance, credit penalties in all sorts of other insurance markets. They find that in most states, consumers with perfect driving records and poor credit pay more for auto insurance than drivers with a DUI if they have high credit. And here in Michigan is the highest credit penalty state of any state in the country for auto insurance. So Michigan consumers with poor credit pay about 263% more than for the exact same policy than folks with higher credit. So just to summarize here, and then we'd love to take some questions. Consumers want to share risks, but want risk-based prices to reflect causal relationships. In the home insurance market, credit scores don't serve really any price signaling function, and so can't really be part of our climate mitigation adaptation strategy through private insurance, but seem to have these huge effects on prices, which might obscure in some ways the environmental risk signal that insurers are purportedly trying to communicate to people. And then also just reflecting on who is this price signal for, and what does it mean to be using these composite individualized metrics as proxies, doing all this proxy work for really complicated collective environmental risk in terms of how we price it, how we share it, how we manage it in these big financial markets. I mentioned that we also have we have the quotes for every company. So we're also doing some work on how much does market concentration matter for prices, especially as insurers exit, the big insurers exit a lot of markets like California and Florida. This is just the average marginal effect of credit for every company in the United States that collects credit information. So there is a huge company level difference in how much they use credit for pricing. So that's another thing we're digging into. And then ultimately, this work is feeding into several different policy formations that are happening both at the federal and state levels. So there's a big discussion happening around should we be regulating the allowable variables home insurers can use? Some folks are kind of pushing for an ACA, Obamacare type overhaul of the home insurance market. Other folks are pushing for overhauling the public programs and moving towards a more progressive income-based home insurance model. And then the government actually doing the risk reduction directly. So how much should we be relying on these private market price signals to reduce risk versus taking a much more hands-on approach with things like land use policy? And then the last thing I want to mention is, again, in hopefully ongoing work with this linked census data, we're also doing some work on sort of what are the demographic consequences of all this decision making in the financial market. So who are these price signals for? Do price signals affect outmigration in different ways that vary by income, in ways that we can actually start seeing in migration flow data? And then also these questions of what happens to housing stock where people are being displaced, where people maybe are responding to price signals. Are similar folks moving into that housing? Is it getting flipped in, what used to be a long-term stable investment of a single family home? Are those all being flipped into sort of rent extraction machines on the coast up until the point they flood? I think these big questions of what's happening with housing stock as people are moving and responding to these. So I'll stop there. I just want to thank this work wouldn't have been possible without collaborators at both the Climate Community Institute as well as the Consumer Federation of America, who really coordinate a lot of this data agreement and handling. Yeah, thanks.